Hello, hello. Happy New Year, everyone. Happy New Year. All right, just getting everything ready. Pressing all the right buttons. Let's do it. Right, so nice group of people. Hello, Perry. Hello, Ian, Greg, Adrian, Michael. One or two others obviously on the way. This is the first session for the new year. We're halfway through the month. And Friday the 13th as well to boot. So if you're superstitious, then this is not a good day for trading. I've never bought into all that nonsense personally. The interesting thing about superstitions, I used to work with some floor traders many years ago, and they were some of the most superstitious bunches of people that you could ever meet. To the point where if they were having a lucky streak, a winning streak in the pits, they would try and recreate the day and the events that caused the winning streak, to the point where if they had been out on a bender the night before, got in a fight and lost a shoe and had to walk home and stayed up all night and got back to the pits without any sleep, they would recreate the day quite literally, because they felt that that was what contributed to the winning streak. There was all sorts of weird, funny things, like people would wear the same shirt, the same tie. They'd start fights with people. Literally, there was renowned for having fights in the pits. You needed thick skin to work in the pits. But some of the stories that they told me were absolutely ridiculous. Anyway, that's not really helping us right now. I'm just giving everyone who's logging in a moment to log in. So welcome one, welcome all. So what are we going to do? Well, we're going to look at what I refer to as production line trading. I typically reveal my most mechanical version of the strategy as much as we can in these open sessions. I go as much as I can and give as much as I can away in the hour or so that we have together. At its base level, it is a mechanical rule-based strategy. There's a few augmentations that we can add along the way. And the way I like to think about the discretionary analysis is it's an optional extra. It's not mission critical, but if you can assess and evaluate the markets, which only comes with time, practice, and experience, then you can layer it on top. So I will find the trade first, buy the dip, sell the rally, for example, and then optionally, I can add in and analysis. And I see down 3, GAN 3, Elliott wave theory. I've got this MACD cross, whatever the thing that you're an expert in, because you all bring something to the table and you can layer it on afterwards. And the point I'm getting to is I rarely lead with discretion these days. I'm not starting my evaluation of a trading opportunity with discretion. I'm going to find the opportunity that the algorithm says to me, this is a good setup. Then I can layer on my knowledge again, should I choose to. Again, these days it's not mission critical, as you'll see shortly, but it just allows you that optional choice that if you happen to see something you recognize, you can add it into the mixing pot. Just like using a food analogy, just like you're going to eat a meal, and it would be comparable to adding herbs and spices, salt and pepper to enhance the flavor of the meal that you're already going to eat. So that's the principle behind the way that I view my trading strategies. So if you are looking to profit from a daily, weekly, and monthly swing in the markets, you're in the right place. If you're looking for underwater basket weaving, then you've clicked on the wrong button somewhere. My basic philosophy, as you've just heard me talk, is that trading should be simple and ultimately should work, not just for me. I mean, I know what I've been doing. I've been noodling around in the markets since the mid-90s. I was full-time since the early noughties. So I've been doing this a while. I know it works for me. It should be simple enough for you to replicate regardless of experience. That's what I mean by that. It should be simple and it should work for everyone regardless of your experience. And if you want to enhance the flavor of it, then you can certainly do that with whatever you bring to the table. I'm going to outline my number one money-making pattern, essentially buy the dip, sell the rallies, but more specifically, we're going to find a dip worth buying and a rally worth selling, because we don't want to buy every dip and sell every rally. Otherwise, we'd be on the fast track to the poorhouse. My ultimate mission is to give you the right tools, the correct rules, software to assist you, provide this community to support you, and should you allow me to, be a mentor to show you the right way. Certainly the way that I found that works for me and many of my students. And the bottom line is so that you can get real results in the fastest and smartest possible way. And I do that with, again, what I do, or refer to as, let's tie up my tongue, called production line trading. And as you heard me say, one of the patterns is buy the dip. But the first thing to point out to each and every one of you is that buying the dip, or BTFD, it doesn't mean what you think it means. Just because we're seeing a downward movement in the markets, or a stock or a currency, or insert the thing that you want to trade, it doesn't necessarily mean that it's a dip worth buying. So that's what I'm going to draw the distinction between today and how I qualify and quantify those things. So we're going to find a dip worth buying, and we're going to reveal the process that I use to do that on a regular, consistent basis, so that we're not guessing, and more importantly, so that we're not sitting at the charts, flicking through chart after chart like a mindless zombie, hoping that the next one is the one. Neither will you have to do this triple time frame nonsense. And I appreciate it as a methodology that works, but the trade-off is you've got time frame conflicts, you've got time invested. You can spend quite literally hours going through all the various time frames in an unproductive way. Like what you'll see with me is that we can do all of this on one time frame, and we can do all of this on one indicator. We don't need to add all the possible trend lines and indicators and tools and widgets and whiz bangs. So we don't need to stack all the bullshit that most people tell you to do. And for most people at the start of their journey, and I did this as well, you put every fucking tool on the charts anyway, just because you don't know what they do. So you know what, you might be missing something, and you're trying to evaluate, trying to assess, you're trying to teach yourself. And it's not necessary. You need one tool, one time frame, one chart. Gimme fried chicken, as Freddie Mercury used to say. So anyway, the point is that if you're not getting results and you're over analyzing, maybe you are making it up as you go along, maybe you're fumbling entries and stops and targets, you're doing the DIY thing as we just mentioned, perhaps you're zombie trading and flicking through chart after chart, you won't need to have mediocre results, because we're going to be zeroing in on the best opportunities, as we'll demonstrate in a moment. So if you're feeling frustrated and that this trading thing isn't working for you, then we can put all of that to one side and start with our best foot forward, new year, new me and all that nonsense, and learn a production line process. I refer to what I do as a production line for a reason. If you imagine a factory, we're going to put the raw materials in, we're going to move our trade idea along the production line in a methodical, mechanical way, so that we have a consistent outcome, just like a factory production line, so that we're not getting stressed out, we're not second guessing, we're not having sleepless nights, we're not having the anxiety, we're not wondering where the trade is. And if you ever find yourself asking, where's the trade, I would argue that you're doing it wrong. And I did it this way for a long time before I came to the more rule-based trading that I do. And I can look for the trade and do the discretion with most, with the best of the rest of them. But it's hard work. It's intensive. It causes, even if you've got experience, uncertainty, anxiety, because there is that self-doubt of, have I assessed things in the right way? So personally, I want to remove all that from my own trading so that I can make a confident statement of, there is the trade. And that's what I want for my own trading. And it turns out that some of you want that for your trading as well. And for me, it gives me certainty, it gives me peace of mind, and it gives me consistent results. Again, there's going to be good times, there's going to be bad times. I'm not promising that every trade's going to be a winner. You might have good months, good quarters, bad quarters, but that's just like any other business in the real world. We've got to take the market conditions for what they are and what they give us. So everything comes with a cautionary tale, and I'm never going to blow wind in your sails that every trade's a winner. There's good trades, and again, amongst all of these, there's bad trades. Students obviously get results, and they have good results, and they have some, poor periods of time as well. And that is part and parcel of the course, because the idiot gurus promise every trade's a winner. It's going to be 100% success rate. You're going to 10 bag every trade. And it's just not true. It is just not true. So I'm going to hopefully dispel that for you today. I'm going to show you what I do. And if you want to do it for yourself, then you'll have enough to make it work. If you would like to go a little bit deeper, a little bit further, a little bit faster, you can work with me. I don't work with everyone. I am a trader first, and I'm an educator second. I love doing it. I get a lot of satisfaction from it. But, if it's not right for you, I'm not afraid of saying, hey, this might not be right for you. Anyway, as I've said, what I refer to, what I do as a production line process, we have a family of strategies these days. The core of what I do is trend trading with stocks. I typically use stock options as an alternative, so we can trade the trend with the aim of capturing monthly and quarterly swings. We've got short-term swings to capture weekly and fortnightly swings on a few short-term stocks. We've also got the opportunity to capture the main move of the day on S&P futures. For Forex currency, the DAX, depending on where you are in the world, it works quite nicely. We can also day trade the morning swing, the opening bell, that first 1 to 2 hour momentum move that some stocks do. This one's quite unique because we can find a footprint that lets us know today if there's an opportunity for tomorrow. Again, these are all part of the strategy family, and they're all back tested, time tested, forward tested, sideways tested, real time tested. You know, they've had a lot of money put to them, simply because these are strategies that I've used and in the last couple of years managed to finally systematize to the point where they are rule-based trading systems. And it just mentions, you know, if you want to capture daily, weekly, monthly swings, it works on stock options, Forex, crypto. I don't personally trade crypto, but it does work on that as well. Futures, DAX, crude oil, and I'm constantly finding ways to trade other instruments. So there's something for everyone is the point. The only reason why you wouldn't trade everything is personal preference. Maybe you don't want to trade futures. Maybe you want to trade stocks. Maybe you don't want to trade crypto. That's fine. It's finding what works for you is one of the difficulties amongst trading. We've got a system that works on a basket of opportunities. So you can quite literally just pick the one that you want to trade and get going. A quick announcement and then we'll hit the charts. I've got a relatively new podcast. I started this late last year. This is my second podcast. If you search AntiVestor in your favorite podcast player, you'll get my mug pop up in an image that looks like this. So if you want to follow along and tune in once or twice a week that I post and publish, we're about 25, 26 shows in now. So I'll be increasing the catalog as we go. And if this is your first time, I can see one or two new names and new faces. Before we dip into the charts, my name is Phil Newton. I am just a regular guy. I like cake, coffee, good, well, less cake at the moment. So I'm trying to tighten that belt like most people at the start of the year. So cake, coffee, good books, occasionally bad books. I've got a strange and quirky thing for flamingos. We've all got something, but I do like going to zoos, and for some reason, the flamingo is my spirit animal. I've been at this since the mid-90s. I started hand-drawing charts in the 90s, which was an eye-opening experience, mainly because I didn't have a computer. So I was trying to trade FTSE futures, basically hand-drawing charts on graph paper. It was certainly an interesting thing to do. Ultimately, I'm not a Wall Street guru. I keep saying I'm a regular guy who figured a few things out. I found out what works for me. And legally, I've got to say that past performance is no guarantee of future performance. What I can demonstrate is that it does sing from the same song sheet on a regular basis. That's why ultimately charting works. Otherwise, what's the point of us looking at it if we don't believe it works? It's not exact, which is why we can't say it's not a guarantee. But it does leave a footprint that is repeatable on a regular basis. So that's what I've already done that one. Maybe the slides in the wrong place, just a regular guy. And ultimately what I want to do is, again, I get my own results, just to thump my chest for a second. But what's more important is that my students get results. They get their own measure of success as well. So if you want to have your own handheld while you learn a systematic approach, then you can do it. Just give some thought to the fact that if you carry on doing what you're already doing, then nothing's going to change. So if it's not working for you right now, maybe you need some help. Again, I don't mind whether it's me or someone else, but generally the fastest way to success is to get some help. And you can only do so much on your own or from the YouTube free things and these free sessions. So if you need help, just know it's out there. Find a mentor that makes sense for you. It is certainly the fastest way to success. I did it the hard way. I figured it out on my own. I Frankensteined it together, and it took me many years to do it. So if you want to plug into a process that works, we're going to go through the mechanical system today. Again, in my own program, we've got a review process, we've got mindset processes, but ultimately my aim is to help you get success and see your own measure of success. So with that said, enough rambling and chasing squirrels. Let's go and hit the charts. So let's do it. So let me just take a quick drink. Let's check in. How are you doing? Adrian, Greg, Ian, Michael? I'm sorry, I'm not going to offend you by mispronouncing your name. Is it Nanda Kumar? Is that right? Correct me if I'm wrong. Perry's, or just tell me to be quiet because I mispronounced it. Pop a comment in the chat box. Say hello if you can. Let me just check that the comments are on. Is commenting on? There we go. Should be. There we go. Perfect. Awesome, Greg. Nice to have you here. I didn't know if I'd had the chat box on. There we go. Right. And that's just code for me, giving you an opportunity to say hello and ultimately for me to have a quick drink. Morning, Zeke. Morning, Perry. Right. Okay. So the philosophy behind what I do, as I mentioned, is essentially trend trading. So let's just scroll back hands of time. If you are new to this system, I'm just going to go back to a bullish trend because it's sometimes more easier and obvious to see something that's clearly well established. Then we'll look at the opposite, which is sell the rally. And again, look at the most mechanical version of what I'm doing. Now, there's 3 lines on the charts. There is the 200, the 50, and the 20-period moving average. There is nothing magical about these 3 moving averages. It doesn't matter what calculation you use. If you want to use exponential, do it. If I use simple, it doesn't matter. Just pick a tool that you're comfortable with. The principles that I use, again, I'm looking at applying a mechanical rule set. So this is why I'm using this. There is no ambiguity over where price is in relation to the moving averages. So when the 50 is above the 200, I'm going to call that a bullish mechanical trend. Because it's a fact, it has happened. There is no mistaking that it has happened, whether it's day 1, week 1, year 1, or your first decade looking at the markets. That has happened. It is a fact. And that's what I'm looking for. When I mentioned earlier, I'm not looking for where's the trade. I'm looking for there's the trade. So I need to make statements. If this, then that. And the posh way of saying that is an algorithm. So and it's, again, most basic, I'm looking for this mechanical trend. So I'm looking to try and trade the movements when price is above all 3 moving averages, or at least 2. Let's just focus on the first 2, the 50 and the 200, just for simplicity. When price is above the moving averages, that's the bit that I want to trade and profit from. And then when price is between the 50 and the 200 period moving average, or between the moving averages, that's what I'm going to quantify as a dip in the context of the mechanical trend, by the dip in the trend. So profit as it moves away and cash outs when it comes back between. And that also presents the setup again for the next trade opportunity. So I'm just highlighting all the times that price came down to or between the moving averages. So you can see that when we have a trend in effect, it can last for many days, weeks, or months. And I'm looking to profit from when price is above the moving averages, above the moving averages. Sometimes it's not going to work out. You're going to lose some money there. But when price is above the moving averages, it didn't work out there, you got lost some money. I'm just highlighting some of the losses as well. So when price is away from the moving averages, we should be able to profit from the move. Again, it doesn't always work. There's some losses. There's one there. I'm just one there. How do I know that that's there? Because these little blue triangles, I'm just highlighting them, they highlight the mechanical trades that I've just mentioned to you. So let's go into things a little bit deeper. So the 50 needs to be above. Oh, come on, black. There we go. 50 needs to be above the 200. We've got the crossover. I'm then going to wait 20 days to avoid false starts and whipsaws. So by that time, price would be pushing away. And I'm looking for a time where price comes back to the 50-period moving average. I'm going to enter a trade as it goes back above and pushes away. Close the trade when it comes back between. So away between, away between, away between, away between. And ideally, we should be looking at profitable opportunities. It's not perfect, but it's mechanical is the point. There's no ambiguity. Now, what it means then is if I sprinkle in the money management method that I prefer to use, then I can quite easily say, well, is this a profitable strategy? If I just bought the dips, as I've just described, bought the dips and sold the rallies, did the opposite, sold the rallies and profit from a downward movement in the markets and profit from upward movements in the markets. This is called swing trading. If I just did that, nothing else, I didn't think about Elon's tweets, president's tweets, if he tweets the nonsense, the CPI, the RSI, the PPI, didn't worry about the Dow 3, the GAN 3, didn't worry about discretion, didn't worry about wars, inflation, stagflation, deflation, didn't worry about any of the bullshit. If I didn't do that, at the click of a button, I can just say, well, what would have happened if I just did that and continue to do that over the last 20 years? So since it takes 1 or 2 years to get a run in. So the date starts from 90. It actually starts from around about 2000. So from 2000 to now, the last 23 years, if I just bought the dip and sold the rally and didn't think too hard and just put the trades on like the chart said, then we're looking at a steady equity curve. Again, then don't worry about the numbers. This is non-compounded, but this is what I'm looking for. This is what a positive expectancy strategy looks like. Now we can see right now it's a little bit mixed. There's a couple of profitable trades, a couple of losing trades. That's just relative to the lack of trending behavior. So let's go and look at that and see what we mean by that right now. So that's what I can do. So I can validate the strategy and validate the market as being a good market to trade and a good strategy to trade the markets. So last year we had, again, there's our crossover, the 50s below the 200. So I'm going to be a mechanical bearish trend, but there's not that many trade opportunities. It's been a little bit whimsical, a little bit lackluster. The moves have been hard and fast, but not very long-lived. So it's not really been a great year for trend. Again, there's some pockets of good opportunities, as we can see there, but it's not been a great trade. We've not seen the big sweeping trends. It is trending. It's rallying and selling off. It's rallying and selling off. It is waving lower, but it's just not behaving, or hasn't in the last 12 months behaved in a way that is ideal for our opportunities. So the next part of this process is, okay, well, the strategy works, and it works on the S&P 500, it works on the markets, the S&P 500. So this is going to be my benchmark. So there's going to be times where, okay, well, this strategy, it did okay last year. There was a couple of profits, a couple of losses, but it wasn't great on the S&P 500. Well, I don't have to just trade the S&P 500. So the next thing that I do, let me just actually put the chart as blank, XXX. So the chart area is intentionally blank. So the next part of making this process work is, one, we've got a strategy. Strategy, that's my chicken handwriting. Number two, we want to trade a portfolio. You are not going to get, you are not going to see an accumulation of, I'm going to say wealth, accumulation of gains. You're not going to see that with trading one at a time. You need to trade a portfolio, and there's a few ways that you can trade a portfolio. You can trade a portfolio of strategies, which is that's what I actually did starting off. You can trade a portfolio of opportunity, ops. So it could be stock, it could be bonds is the usual combination. It could be Forex. You could also trade time frame. You can have time frame portfolio, time frame opportunities. So portfolio is diversity. So diversity. Trying to write with the mouse is not the easiest thing to do, but you get what I'm trying to do. So you can have this portfolio of opportunity, which creates diversity. Again, in stocks, bonds, Forex, timeframes. You can do ETFs, so sectors. Again, you can trade all of them. So what I'm trying to get to is not trade one at a time. You've got one chart, and only trading that for the next 10 years. Again, it will work for you, but you can go further faster. And as we just saw, the last 12 months on the S&P 500, it wasn't great, but there were good opportunities elsewhere. So that's what I'm trying to get across. Now, one of the great things that's happened since 2010, and the next big thing was 2022. So firstly, options in 2010 went essentially full margin, meaning that if you've got margin accounts, then you don't need the margin for the stock. So if you've got a $5 option times one contract, which controls 100 shares, it's going to be $500. So that's your risk on the full price of the option, because I like to trade with options, but that's also all that's required for margin. So the point is you don't need hundreds of thousands of dollars to trade a portfolio of stock anymore. Now, if you can't trade a single, you can use a debit spread. And benefit from the same movement. So if you want to risk as little as $50 while you're learning a process, you can risk as little as $50 should you choose to. Again, I'm just trying to give boundaries again for big accounts, for small accounts, and maybe you're brand new to trading. Maybe you don't. Maybe you've got a big account, but you don't want to put it at risk initially while you learn a process. Again, what I'm trying to highlight is you can trade Tesla for $100 risk if you want to. The other big thing that happened in 2022 is specific to futures. You've got mini micro futures. So instead of risking, so the S&P 500, the contract is ES, but the mini micro, which is the mini, the micro mini is MES, meaning that for every one tick of movement on the S&P 500, it would be at $12.50. Now, the mini micro is a tenth of that. So if you want to have every tick or point, or a tick is the smallest movements on future, it's a tenth. So you can risk as little as $1.25 per tick. So if you want to risk $10, $20, $30 on futures while you learn the futures version of the strategy, if you do want to trade just one chart, one strategy, you can do it at low cost is the point. So it doesn't have to break the bank, especially while you're learning a new process. So it just allows you to effectively sleep at night. Anyway, if you want to trade a portfolio of futures contracts, again, it works on corn, it works on wheat, it works on soy. If you want to be a futures trader, again, you can do that, is all I'm trying to get to. But you still want to have a portfolio of opportunities. Now, what I typically teach is a portfolio of stocks and opportunities. So I've got my top 25 stocks here. Again, I don't know which of these stocks is going to give me a good trade. I don't know if any of them or all of them are going to give me a good trade. What I do know is that on average, this is Apple, on average, over the last 25 years, this has produced a positive expectation, positive return. And on Apple, in the, what have we got? Last year, you've got one or two duds there. And then when we went bearish, you've got some profitable trades here. So I don't know which one's going to be the one that works. So as a result, I know that I've got a positive expectation, but I don't know if the next trade's going to work out. But I know that they work out on average, so that I've got to take the next trade without deviation, without hesitation, so that I can emulate via repetition the type of equity curve that I'm expecting. This is what we need to do. I can't cherry pick. I've not got a crystal ball. I don't know which one's going to work. I do know that they work on average. Does that resonate? Does that make sense, that last comment? So consistency of application of a strategy, this strategy, and to be quite frank, any strategy is vital, but I've got the confidence to do it because I've got a strategy that's proven. So it's kind of like that chicken and the egg, the cart before the horse. Well, I want to trade with consistency, Phil, but I don't know if I've got a strategy that works. Well, now we've got a strategy that works. It's proven to work. Specifically, it's proven to work on this stock that we're now assessing. I shouldn't have any fear that I can't have a positive expectancy, not just on the single trades, because we know we're going to have monetary losses from time to time. But if I trade Apple for the next 12 months, then I should be able to turn a profit. That's the expectation. That's the logic. That's the theory behind systems, algorithms, and all that jazz. So now I've got, let's put the chart area. So chart area is blank again, intentionally. So this is why I've got this portfolio of opportunities. I've got 25 stocks. I tell everyone to, or suggest to everyone to start with 25. Again, my 25 might be different from your 25. That's fine. Why might they be different? Maybe you want to trade stocks that are between $30 and $50. That's cool as well. I've got a list of 500 stocks on my master list that I've laboriously gone through to say, here's 500 stocks that are proven to work over the last 10 or 25 years. So you've got a large list of stocks that are proven to work with this style of trading. Again, the counter to this is Pepsi. Let me just go to what I'm not looking for. Pepsi Cola. I'm sure we can all agree it's a good company. It's got good dividends. It's a multi-mega cap international, man of mystery, all that jazz. It's a good company is all I'm getting to. You know, without looking at the balance sheets, everyone knows it's a good company. It's been around for a long, long time, as has Coca-Cola. But does the price behavior, I don't care about the company, I want to know about price behavior. Does price behave in a way that's favorable to the way that I want to swing trade? Let's click the algo. Actually, no. I'm not saying it's a bad company. I'm just saying that this is the wrong strategy for Pepsi. So it doesn't mean that I can't trade Pepsi. It just means that I'm not going to take every trade blindly without bringing, well, in fairness, discretion to the table. I'm trying to remove discretion. I don't want to second guess. I don't want to know, is this the one that's going to work out? That keeps me up at night. So I want to remove Pepsi from my universe of tradable opportunities and say, you know what, I'm not going to worry about Pepsi. Now, if I want to trade that, I need to bring something else to the table and temporarily trade it. Again, I don't see the point in doing it, but if you wanted to, you need to bring something else to the table is what I'm trying to get to. So I'm not trading Pepsi because it doesn't have a positive expectation. There's the zero line on the crosshairs. It's got a negative expectation. Okay, so Pepsi is not the best thing for me to trade with this style of swing trading. Temporarily, if we look at the last 12, 15 months, the last 2 years, it worked in the last 2 years. I'm not saying it doesn't work, but it hasn't worked for 20 years. So I'm going to second guess myself. I'm going to wonder if this is the one that's going to kick me in the shins because it doesn't work on a regular, consistent basis over multiple occurrences. So let's leave Pepsi out the equation. So I've got 25. So these 25 stocks, these have all got a positive expectation. My theory, my logic is that they should continue to work for the next 12 months. It's a logical conclusion. Again, past performance, no guarantee of future performance, but I'm expecting there to be no breakdown in the way that price behaves. I'll evaluate it again in 12 months. Are these still the right 25 stocks? So what I can do, what you've just seen me do with, again, chart area is intentionally blank. This column here on my watch list, this tells me, is the 50 period, the trend, above or below the 200 period? So these are all the stocks that are in a bullish trend and a bearish trend. Now, for anyone who's been watching this for any length of time, for most of last year, the last 12 months, we had maybe 80% of our top 25 were bearish. So we're now kind of seeing a little bit of balance where we've got almost an equal number of bullish and bearish trades, bearish opportunities. So now these are separated. So this just highlights another element to the strategy. If I've got a portfolio of 25 stocks, I've got a number of bullish candidates, a number of bearish candidates. And let's just say that I've got, you know, three or four bullish trades on and 3 or 4 of those bearish trades on. Maybe I've not got all of them because not everything's going to be on and open at the same time. There's going to be some that are resting, some that are ready to go. But let's just say that we've got 3 or 4 positions of each. Well, now it doesn't matter if the market goes up or the market goes down, because the portfolio should, in theory, and again, it's not perfect, but it should, in theory, be hedged. The bullish trades should swing up in a bullish upswing, not a bullish market, a bullish upswing. And the bearish trades should swing down in a bearish downswing, regardless of what the market is doing. That's the theory. Again, there's exceptions to every rule. It's not perfect. It is infallible. But this is what hedge trading, or my version of hedge trading, is. So I've got to take not just the one trade, but I've got to take these 25 trades and or assess them on a regular, daily, weekly, monthly, consistent basis for the next 12 months and take whatever comes. On average, I'm expecting a positive return. It's kind of like, and it's not necessarily mean reversion, but yes, there is an element to that in it. But this is essentially what hedge funds do. This is certainly what I used to do in Forex when I ran my funds. We'd have a number of, I used to have time frame diversification, strategy diversification, and that gave me this bullish, bearish portfolio. It didn't matter what was going on a short-term basis. You know, we didn't really care about the long-term trend at that point, but we were just looking for different strategies to unfold on 4 different currency pairs. It's the same principle. So you've got a number of stocks that you can trade, and it shouldn't, again, theoretically matter which way the market's going. It breaks down when we've got a non-trending environment. Yeah, absolutely. Yeah, perfect, Brett. It's a delta neutral strategy. That's what a hedge fund essentially is using. I use trend trading to apply the same principle as the bottom line. And there's going to be times where it breaks down. Again, I'm not going to blow wind in anyone's sail. It's been a difficult year for this style of trade. It's been a difficult year for trend trading completely. So if you're, break even, if you're doing okay. I mean, I was like single-digit profits last year on one account. I was slightly negative on my other accounts just because I started the account at a slightly different time of the year. So you just missed out on some of the good moves. I had one student, she was telling me she started in November. She'd had 7 trades, and 6 of them worked out positive, just because the time of year she started and the portfolio that she had selected. Her top 25 stocks were coincidentally good swing candidates for relative to when she started. So again, what I'm trying to highlight is, as with any other business, there's good periods, there's bad periods, there's good weeks, months, years. There's going to be mediocre. I mean, last year was mediocre for trend trading. We looked at that actually before Christmas. In one of the sessions, you can quite literally Google hedge fund performance. You'll get some review statistics. There's lots of websites out there that review what's the word I'm looking for, that reviewed the hedge fund performance over a 12-month period. And for trend trading, it wasn't a great year. So, I've got to live with mediocre performance. Yes, the broker did make money, but yeah, but you all get what I'm saying, don't you? You all get what I'm saying. It's not a perfect system. There's no perfect system. There's no holy grail. And I've got to admit, when I stopped looking for that holy grail, that's when my performance started to accelerate. I came to terms with the fact that I'm going to let what the market gives me or takes away from me be what it is. It is what it is. Because I don't know, for the same reason, I don't know if the next trade is going to work. I don't know if the next 10 trades are going to work. I know there's going to be a period of time where nothing works, which is what I saw at the August to October period of last year. Like, nothing was working. Nothing was really swinging. Everything was very short-lived. But then the whole year was kind of lackluster anyway. The good news is, that type of performance, you're going to get 1 in 4, 1 in 5 years, like we saw last year for trend trading. And typically, the year after a bearish year starts to see an increase in volatility, which is what we want. And we start to see more generalized trending behavior. So historically speaking, we can anticipate this year to be interesting for this style of trading, which is trend trading. Right, so let's get off. We saw a squirrel and we chased it, didn't we, Brett? Let's do it. So we've got a bullish trend, we've got bearish trend. Now, you notice we've not looked at a chart yet. The next column here says, okay, how many of those stocks are, is the number above 20? Because remember, we want to wait 20 days. So it's just going to count the days for me. If it's above 20, then it's game on. This next column that I'm highlighting, I want to see price. Again, let's just focus on the bulls. I want to see all bullish. So we've got all bulls there. So we've got a bullish trend, prices above the 200 period moving average. Great. Let's just sort the next column. So now the next round of stocks, these are all above the 50 period moving average. Cool. So we've got a bullish trend, prices above the 200. Great. It's above the 50 periods. And without having to sort them, we can see that these group of stocks are all above the 20 period. But let's just put it the other way. So we've got one stock that is trending here, but has dipped below the 20 period moving average. So what is that? It's a dip that we've defined in the context of a trend. Let's go and look at ABC. We're expecting to see a trend. What do we see? Make sure we've got enough data. So now I'm looking at the chart. So everything starts in the watch list. I found a stock without having to look at the charts. I've got a bullish. There we go. So I've got a bullish trend. It's been in for 20 days, above the 20, above the 50, but below the 20, but above the other two moving averages. Let's just mark it off. Expecting to see a trend, got it. Its price is above the 200, above the 50, but below the 20. So this is our dip in a trend. So all we want to do is just confirm what we see. Visual inspection. Do I see a trend? Yeah, start at the bottom left, finish at the top right. Don't overcomplicate this. For that to be in effect, usually we would expect to see a trend. Visually, we can see that it's trending. Great. I'm looking for a trend. I'm expecting to see a trend. I'm seeing a trend. Fabulous. So now, there's the 50. There's the 200. There's the 20. So two choices. I can get in a trade now, and the algo's already fired off. You can see that's what that blue indication is. The algo's already fired off, automated, saying we've got a trade off the 50-period moving average. So if I want to be conservative, I can wait for price to push above the 20-period moving average and place my trade. And then it's a case of sit back and wait for the trade to unfold. Again, you can see the same thing over here. Price rallied, came back to the moving average. So you've got that little profitable trade just being highlighted there. It went back above all three moving averages. That's what that triangle is. It actually had a 2 target exits. You've got that being marked up. You can just see the little dotted line. That's the algo firing off the trade. You've got one here. You can see that didn't work out. You've got a monetary loss there. You've got another one there. Now, this one wouldn't have been taken because of that trade. Now, one of the things that I mentioned earlier is I like to use an option as an alternative to trading stock. So I'm going to buy one strike, the first strike out the money. And let's just say it's at the 160 strike. I think it was the 157.5 actually, but let's just say it was the 160 strike. I'm not going to close. I use the full price, the premium as my built-in stop loss. And I also buy 150 days worth of time to make sure I've got enough time on the clock. So we've got a fair amount of time. So what that means is that if I have a trade, again, I've got all the other trades, they're working fine. But then this one, the last one in the trend for last year, isn't working. So I'm going to use the full price, the premium, as a built-in stop loss. I'm going to give myself 150 days to expiration minimum. So 3, 6, 9, 12. So about there. So at about there, it would expire worthless, which means that I avoid one trade there, a second trade there, which you can just see, and a third trade there. So I'm taking the first trade, but I'm avoided trade number 2 and trade number 3, which would have produced a monetary loss if I was trading with stock in the traditional way or using an option with a traditional stop loss. I'm going to use the full price of the option, make sure I've got enough time on the clock so I avoid all the usual Greeks and the bullshit that comes along with trading options. You minimize it, you don't get rid of it, but you minimize the early exposure to it. But it means that I also start to outperform my own algorithm because I'm avoiding the losses. I'm going to take a loss. Does that make sense? I'm going to take the loss, but I'm avoiding the other two at the same time. I'm going to take that loss, but avoid these two losses just by moving from stock to a stock option with plenty of time on the clock. And you want plenty of time. This is the backup plan. There's going to be a time where if you've got enough time, I can't remember if I'd managed to do it on ABC. I did it on a few others. But if you'd had enough time, and let's just say the 150-day expiration was there, should price rally back, you can have the opportunity to get a break-even trade. So then you avoid all 3 losses just by giving yourself plenty of time, firstly, to be right, and then secondly, to have a backup plan. Because very often price will give you an opportunity to come out at break even. We spoke about this at length last year. There's a few examples on Apple at the beginning of last year. Let's go and take a look at it, actually. Apple at the beginning of last year gave me a couple of those choices. So you can see some of my trades marked off just in the shaded areas. So we've got a trade there, which would have yielded a loss. So you've got, so I avoid that one, I avoid that one, and I close out at that one, I avoid that one. So I sit through all of that retracements because I've got 150 days minimum, might have more, but never less. 150 days to expiration. So I've taken one trade, sorry, my apologies, that trade there. You avoid the second, the third loss there because I'm looking to manage this trade. So as price rallies here, I'm going to close that out for a break-even trade. That's one of my favorite trades of last year because it didn't take the loss. I wish they were all like that, but that's just the way it works. Now, the same thing happened over here. So I've got this trade here. Price rallies. Holy shit. What are you going to do? There's no benefit to closing that. I've got all the time in the world. So what I did with a new entry setup, you can see the shaded there, new entry setup there. As price sold off, net, like that's trade closed for a loss. This trade closed for a profit, but altogether, there's a small profit. Let's just call it a break even. There's a small profit to be had. And then the third one is great. And it's all by moving from stock to stock options. It just gives me choices to manage the trades more effectively. And just by simply following that process, I've got to take the trades. And again, it's worked out that all of last year on Apple, on paper, according to the algo's losing money there. The algo's losing money there. The algo's got a small profit there, small profit here. But just by moving smartly from stocks to stock options, you don't have the capital intensity, and you also have the chance to manage the underperformers in a more effective way. Does that last point make sense? That last part makes sense. It's the secret ingredient. It's one of those little herbs, secret blends of herbs and spices that makes this work so well. Great. So we've got ABC. Perfect, Brett. Thank you very much. So this is one of those things that just makes it all work together. There's not just one thing that makes this style of trading work. It's not just the strategy, it's the way that you approach it. Again, work comes with, firstly, you've got to have a strategy. Secondly, you've got to apply a portfolio. Thirdly, moving to options gives me choices, or using stock options as an alternative to stock, it gives me choices. It also opens the door for small account traders to trade debit spreads without it being capital intensive. Now, the next thing, now I've got all of these separated off. Let's just bunch all the bulls and the bears together. I've got this little indication. It's a little bit, we're not going to have time for me to explain this, but I've got this little tool here. It does a lot of heavy lifting in the background. It's going to say, which one should I look at? I'm expecting, let's take a look at LNG. I'm expecting to see a bullish trend. Am I seeing a bullish trend? Well, yes, it is a bullish trend, but right now price is at the 200. So what I need to see is for price to be above all three moving averages. Now, just in the interest of disclosure, here's my trade, LNG. I took a trade there. Again, I've got a previous trade there. It's working out nicely. I've got another trade here. It's underperforming is how I like to phrase this. But I've got until expiration to sort it out. So hopefully, if we can see a rally, then I'll be aiming for a break-even trade at best. That'll be what I'll be looking for. Small loss, small gain, break-even essentially. That's what I'm looking for. I've got the opportunity to manage it more effectively. So I'm not going to take that yet. A new trade will happen above all three moving averages. It's not there yet. But what I get to do with when you've got a rule-based system that you know what you're looking for, and you should be able to do this with any strategy and change it from where's the trade? Where's the trade? Oh, I want to buy the dips. Well, quantify the dip, quantify the trend, quantify everything. And then you can approach trading in a very mechanical way and create your own production line. So we've got ABC. We're expecting to see a trend. We've got a trend. The algo's fired off a trade entry. It's going to be above all three moving averages today. Well, it is above all three moving averages right now. So ABC is in a bullish trend. I've got that on my watch list to take action today. Now, the way that I approach this, I've got some entry criteria. The algo is technically already fired off. I'm just restarting in the last few days my own trading routine from the extended break that I took over Christmas. So the algo is already fired off. It tells you where the entry is. So all I'm waiting for is price above my desired entry, approximately $165. If yes, place the trade. I typically place my trades at the end of the business day rather than the beginning. It's personal preference. Again, just part of the rule-based approach that I like to use. The next on the dance card is CVX. Again, we've already looked at this. I've got a trade on here. It's underperforming. Now this one, given the fact that I've not had a deep retracement, I'll see if I can just plug into this new trade entry because I've got this one here from December. I've got plenty of time on the clock and maybe it starts to perform. And if it doesn't, then after a period of time, if I can close it out at break even, I will. Again, I've got choices. I'm often going to be early to moves, particularly when the markets are not great, but I should never be late to the party. Should never be late to the party. Right, we're coming up to 10 to the hour. Why don't we, for a bit of fun, why don't we take some stocks? Are there any stocks that you're looking at that you want me to assess? I can just very quickly click my button, and if it's got enough data, we'll take a look at whether it's worth trading. So any stocks that you're looking at, throw the ticker symbol in the chat box, and we'll plug it into the algo, and we'll see if what you're looking at makes sense to trade. BBY. Okay, let's do it. BBBY. So this is Bed Bath and Beyond, isn't it? So Bed Bath and Beyond. Now what I do know is prior to this, all this nonsense, the meme stock thing, it has been a good trader. And it has been a good trader for me in the past. And I have traded this over the years. Generally, I like to trade stocks that are over $20. Yeah, absolutely. It's fine for Frankfurt, hasn't it? I like to trade stocks that are over $20. So just by that measure, it gets excluded. And I generally don't get involved in the meme stock nonsense anyway. But is this, so let's put the algo on there. So this is going back over as much data I've got over the last 20 years, 23 years. There's the zero line. Remember, this is non-compounded. So are we making money or losing money? And should I trade this on a regular, excluding the fact that it is filing for bankruptcy and it's a meme stock and it's a shitty penny stock at the moment? Is it worth trading on a regular basis, Brett? You tell me. Based on everything we've discussed today, should we worry about trying to trade with this style of trading? Doesn't mean you can't. Again, there's ways of trading this, but it's just not part of my strategy at the moment. But is it worth trading? Yeah, absolutely not. For most of the last 20 years, for this style of trading, it's been underwater. There was a big pocket of profits there briefly. So let me just give you a date. It was, for this style of trading, it was great from 2015 to 2019. So it has performed. It's just, it doesn't perform on a regular basis. And what I'm trying to get to, it doesn't mean you can't trade Bed Bath and Beyond. It's just, you're not going to trade it with this strategy blindly. Yeah, you're not going to, absolutely. You're not going to trade it blindly is the point here. If you are going to trade it, like we said with Pepsi, you need to bring something else to the table. Okay, so Bed Bath & Beyond, this is a meme stock. So this is a candidate for pump and dumps. So you need to switch tactics and strategies that are more suitable and responsive for pump and dumps or penny stock pump and dumps. Again, there are strategies that will help you do that. It's just, I prefer not to do it. I have done in the past. I just don't want to be involved with it anymore. It's too time consuming to trade pump and dumps. Again, I want to be done and dusted in a very short space of time, most of the time anyway. So BBY, it's not great for the style of trading. So guess what I'm going to do? I'm not going to worry about it. And then plus all the other meme stock and bankruptcy nonsense. So from Nanda Kumar, hopefully I'm pronouncing your name right. It didn't tell me off earlier, so I'm guessing I have MULN. Let's take a look at it. Mullen Automotive. Oof. A true penny stock. 37 bright, shiny pennies. To be fair, you tell me. This is, so the zero line for the profit and loss is right there. Is this a stock? Fabulous. Is this a stock that is ideal for this style of trading? Again, doesn't mean you can't trade it. Again, I want to emphasize that it's just that this strategy is not matched with this stock. Again, think about it. It's like to be a little bit crude. We're doing the trading equivalents of Tinder. We're swiping left and right, trying to match strategy with the stock. I'm looking for a stock that has a positive expectancy for the way that I want to trade. So that means that I can have it as a candidate for my universe or my master universe of stocks. So this is not something that I would look to trade. It's not in my universe. My personal preference is I like to trade stocks that are greater than $20. Again, it's personal preference. You can trade stocks that are smaller. Again, mainly because I know I'm going to trade an option. So I want the dollar movement to be transferred in the option And I just like the higher dollar stocks, which allows that it just gets transferred into it quite nicely. Again, it's not impossible. It's just one of those personal preference things. So this particular stock, it's not fantastic for this style of trading. Again, I want to emphasize, and I'm saying this multiple times, it just means that Tinder trading, I like that, Zeke. It's the trading for Tinder. We're swiping left and right, trying to match strategy with the stock, the right strategy with the right stock. And when if both swipe left, I've never used them. If they both swipe left, then we're going to match them up. QCOM. Again, QCOM, I've traded QCOM many times in the past. It's been a good performer from a discretionary point of view. But when I plug it into the algo, I removed it from, again, the algo for me is about 3 years old now. I managed to finally completely automate the decision-making process. So while I've had great trades on QCOM from a discretionary point of view, I'm not going to take every trade on QCOM, and I've removed it from my universe because the way that I trade these days, this is not a stock that behaves on a regular, consistent basis. Now, the caveat, as I keep saying, it doesn't mean you can't trade QCOM. It's just I'm not going to trade it every day, every week, every month, take every possible setup that could develop without bringing something else to the table. You need a little bit of discretion. Again, personally, I don't, because I've got a master universe of stocks. I've got 500, that's plenty for everyone, that have been seen to behave favorably for this style of trading. So if I'm going to go looking for something else to trade, I'm going to look at that top 500 because they behave in a very favorable way for the way that I want to trade. Does it work on, I've got a private queue, so I won't name and shame you. Does it work on sectors and ETFs? Yeah, it does. So QCOM, this is semiconductor, isn't it? So you can do it on, let's take a look at semiconductor. So you got, what it is, QCOM, I can't remember now. QCOM, am I getting confused? Is it semiconductor or is it something else in, is it bio or whatever? Who cares? It doesn't matter, does it? Anyway, does it work on ETFs? Let's take a look at the sectors. Yeah, it does work on ETFs is the short answer for that person that was asking the question. So if you want to trade just ETFs, you can do. So again, this is the semiconductor ETF named SOX. And again, this goes back over since since 1999. So do we have a steady equity curve? Again, this is non-compounded. So this is just $1,000 in, and you're going to get about $27,000 out. Again, don't worry about the numbers. All I'm looking for more than anything is, do we have a nice steady equity curve? And yes, we do. There's a few other things that I like to look at, and you can get the breakdown of the individual metrics. You know, these softwares give some very detailed reports, but the primary and the first thing I'm looking at is there a positive expectation? And do I have a trending equity curve from this? Yeah. Okay, cool. So I'm going to include this in my universe. Now, what I can also do is based on the ETF, I could go and look at the individual components of the ETF or just the sector at large. So I've got some AMD. So if you wanted to specialize in a sector with this strategy, we've got AMD, we've got Avago. I love that. Oh no, it's Broadcom, AVGO, Broadcom, Avago. So this is probably a good example of a stock that has a positive, we've got there's the zero line, positive dollar amounts, but can you see how it's not trending? It's been a good performer in the first few years of existence, but then the strategy has essentially been range bound. Win a few, lose a few, win a few, lose a few. So this is why I don't look at the headline number. So if I just looked at the headline number, we've got a positive outcome there on the headline. And this, hopefully you can see, well, I've got a positive headline, but the detail on the performance graph saying, well, actually, it's got a positive headline, but it's not like AMD, where it's consistently trending. Can you see the difference? And this is one of the things that I like. Okay, so if I had to choose between Avago, Broadcom, I just like saying Avago, AVGO, Broadcom, if I had to choose between Broadcom and AMD that are in the same sector, it's going to be AMD. Does that make sense? So other things, other intangibles with having a mechanical strategy that we can plug into an algo, if you like. is we get to, well, if do I choose this stock or do I choose that stock? Well, you're trying to build your top 25, or you're trying to look at the best stocks for trading in the sector. Okay, well, AMD is great. Maybe I don't worry about AVGO because it's not fantastic by comparison, because we don't have a steady equity curve. Again, comparatively, Lam Research, is this one that snuck into the semiconductor? Am I looking at the right list here, Phil? Just talking to myself. There we go. Steady equity curve. MU. Micron Tech, steady equity curve. Can you see the difference there? And go back to AVGO, Broadcom. So I want to try and avoid stocks that don't have, not necessarily a big headline number, but I'm looking for that trending behavior. That's what I'm looking for. I'm looking for that trending behavior. So AMD's got it, MU's got it, NVIDIA's got it, NXPI, Skyworks. These are all great stocks, certainly in the sector. So if you wanted to specialize in a sector, you can figure out, okay, well, which stocks in the sector are right relative to the strategy. And you can certainly specialize in an ETF or the individual components of a stock as well. So I've got an ETF list here if you want to have a little look. Stocks that perform well are the steel ETF, solar ETF, energy. Energy is one of those sectors that it just performs, everything just does well. And it's not just in the short term because of everything that's going on, but long term. I just want to go back to this one and then we'll finish off on this. Again, this is another reason why I don't necessarily look at, again, the zero line. We look at the first 10 to 20 trades in the last 20 years. They weren't great, but then from that turning point, and this is the healthcare sector, we've got a relatively steady equity curve. So again, just another reason why I'm not looking at the headline, the dollar amounts. Do I have a steady equity curve? And I can make an exception to those first few trades that didn't really perform well and have a look at the equity curve and say, okay, well, long term, over multiple decades, and let's face it, 100 plus trades, the last 100 rather than the first 30, have performed consistently well. Let's not worry about the headline number and just recognize that we've got a nice steady equity curve in healthcare. So healthcare is a good sector to trade for this style of trading. So if you want to find individual components, you can then start to drill down should you want to. Again, there's a nice list there. So you want to take a quick screenshot, please do so right now for those of you asking about the ETFs. And then what we'll do is we'll wrap it up. Before we do though, any final questions, comments, any individual stocks that you want to assess and we'll plug into the algo? If not, we'll hang our spurs up and start to wrap it up. Cool. Right then, let's do it. So thank you all for your time and attention. Any final questions, please feel free to ask. Where's my slide? Bear with me. There we go. So so thank you all for your time and attention. Oh, sorry. Question from Adrian. What do you think about covered call on an ETF? Yeah, that's certainly a valid strategy. So covered call, buy stock, sell options. That's certainly a valid way of doing it. There's nothing wrong with it at all. Appreciate that's a very quick back of the envelope answer, Adrian. If you want a more detailed response, shoot me a message in Slack. Where was I? Oh, yeah. So thank you, as always. The first one of the year. Hopefully it was a good one, a nice strategy recap and roundup and looking at some individual stocks and sectors. These sessions wouldn't be what they are without you. So thank you for your time and attention. I fully appreciate that as the most precious thing that you can give anyone. So thank you. My only wish is that you do it. Don't just watch Trader TV and check into these things. Like put what you're learning into action. Small movements made every day, incremental improvements. Where's my fancy slide? So, rather than just have a dream. Again, I saw this, it resonated, but don't just have a dream to become a trader, write a goal down, start breaking those goals down into a plan. But it's this last one here, take incremental action. Whenever you learn something, put it into practice and make it work. I know this strategy works. I've been trading it a long time. We've got the results to prove it. We've got the students who lovingly tell me that they're getting their own measure of success as well. Again, I do this because I enjoy it. I love it. If you want more help going further, faster, just know that you can work more closely with me. And if you want to, send me a message. There's no no hard pitch. If it makes sense, we can talk. If it doesn't, I'll always point you off in the right direction. So with that said, let's hang our spurs up and call it a session. Thank you very much again for your time and attention. I'll see you all at the same time next time. Thank you very much, Brett. Thank you for your kind words. Right, folks, let's do it. See you all at the same time next time. Have a great weekend. We've survived the first part of Friday the 13th. Awesome, folks. See you next time.